Wonder if Dr. Wall's going to join us. Hi. Good afternoon, everyone. Here we are. We're in the second round of presentations. We're moving right along this semester. We have 5 presentations today. 2 will be in the international sector and 3 domestic. Dr. Wall is actually in Miami. If you've been wondering, he's at that large blockchain Bitcoin conference. Hope he did split his leather pants and that his big gold chain is holding up for him in South Beach. We're holding down the fort here in Milwaukee as it's snowing outside. So we'll miss you, Dr. Wall, but we'll see you in a couple of weeks. All right, nice gathering here today. Looking forward to the presentations. We'll follow in order. We're going to start with Andrew and Owens Corning. Andrew, come on up.
All right. Yeah, good afternoon, everybody. My name is Andrew Payne. I'm a junior name program. I'm pitching at Owens Corning today, pitcher OC, at a target price of $123.84, representing 45.43% upside. So kind of just take you through the screening process before we open up to questions. I kind of used the same approach as I did for my last stock. I used kind of a bottoms-up approach where I was kind of just reading through a description of different firms. I was really looking for good historicals and a healthy balance sheet. And I came across Owens Corning because, and kind of reading their about their company and then their investor slides, I really like they return over 50% of free cash flows to shareholders every year through repurchase of stock and through dividends. And then I also really like that they operate in 3 different segments and that all operate in 3 different end markets as well. So that really, they operate in roofing, insulation, and composites. And roofing and insulation are cyclical industries, but I think the composites segment helps to stabilize that, as well as operating in 3 different end markets. And as we've seen right now I'll kind of address some questions that I had on D12. The first one being talking about rising interest rates and interest rate hikes throughout 2022 by the Fed. So this is going to have an effect on Owens Corning, and I have factored that in my model. So kind of what I did, and I guess I can talk about kind of I factor this in my model. So these interest rate hikes kind of led to there's still growth of about 10 to 15% in the first 2 quarters of 2022, and then I have that kind of trickling off and about 4 to 5% growth in roofing and insulation in the back end, and then I kind of continue that trend throughout 2023, 2024, with kind of having composites stabilize that growth as they are pouring their free cash flow, excess free cash flow into CapEx investing in that. And then the other question I kind of had was surrounding my peers. So kind of had some struggles with my peers just because a lot of roofing insulation companies are private or arms of big conglomerates, subsidiaries. So kind of what I tried to do there was I tried to pick 2 companies that operated in roofing, 2 that were insulation, or a combination of those, and I want to do 1 that was really focused on composites to kind of capture that market. So I ended up picking Trex out from that, which did give me a lot of my upside in my relative valuation. But I ended up I took them out and ran my model about it, and I was still getting 31.5% upside without Trex. So from that, I can open up to questions.
All right. Just by way of background, for some people who don't know what we're referring to when we talk about questions, we post a presentation online on Thursday morning, and students have an opportunity to view it and then ask questions. So prior to this gathering here today, there's already been a fairly extensive question and answer session taking place online just with the students in the program. By the way, this was a good week again. There was some very good dialogue that took place. Well, I know you got a lot of questions on this, but it really bears you having an opportunity again to address it. You know, Fed is tightening. I mean, right there it is next to you on TV. We're looking at a mortgage rate over 5% potentially even going as high as 5.5. You know, how strongly is this company's fortunes tied to housing?
So yeah, roofing and insulation are tied to it, but as we've seen, when demand for houses was really high last year, their revenue skyrocketed over 20%. But really the backbone historically of these two segments has been really remodeling, and that's expected to stay pretty strong throughout 2022 and going on. And kind of like I said earlier, they're still involved in some short-term contracts that are carrying over from 2021 that are going to kind of continue to drive revenues in those two segments for at least the first 2 quarters of 2022.
Thank you, Andrew. Let's open up the floor for questions. Who'd like to begin? Who's going to begin?
I'll start.
Maddie.
Great pitch, Andrew. Could you provide a little bit more color on the operating margin increase in 21 and why you're confident on it staying at that 17 level through your out years?
Yeah, so with inflation, so that obviously caused the rise of all raw materials. And one thing, my second risk actually is no long-term contract. They really don't have any long-term contracts with any of their customers. And this really, with rising prices, allowed them some good flexibility in their price cost mix. So really allowed them to leverage this inflation and kind of create these operating margins. And then they've always historically in their insulation business been about 350 basis points above their competition in that regard. So that's kind of stayed steady. And then as far as just sustaining these margins, I do have them trickling down a little bit to about 100 basis points from where they are right now.
Questions? Management's been with them a while. Have you had an opportunity to look at management, and can you render some thoughts about that group?
Yeah, so they actually just had so their CEO is actually fairly new. He's been with the company 25 years, but he's just named CEO in 2020. So he's actually done a really good job just restructuring kind of their focus and their strategy. Announced a new CFO as well 2 years ago when he started. So he's kind of been restructuring the management team as well as aligning goals to kind of expand their composites business, which kind of acted as a hedge for rising interest rates.
Bill,
how meaningful is the new regulation for insulation that you talk about in your write-up? Is it something that people have to do for retrofit, or do they have to? Is it just they remodel? If they choose to remodel, then they're going to have to do the new installation. Can you just explain what kind of impact that new regulation is going to have?
Yeah. So there hasn't been any states that signed on to it yet, actually, but it's been gaining a lot of momentum, and through that regulation is kind of not just insulation; it's kind of just a factor or one of the points of it. So there's been a lot of momentum in other like energy saving and carbon reducing initiatives that have already passed, and there's been a lot of talks over the last year now that this insulation regulation is going to start happening in a lot of states, which would obviously drive revenues for Owens.
One more question,
please.
On their AA ESG rating.
Yeah.
Is it the highest in their industry group?
Yes, it is actually. So a lot of them are actually towards like an A or BBB is what I've seen. But Owens Corning really, I mean, throughout all three of their segments is really focused on sustainability. It's one of their key factors. And I mean, 61% of the revenues right now are derived from products that are energy reducing or carbon emissions reducing. And they plan to have that at 74% by 2024.
Okay.
Who's the most comparable company to them?
So I'd say the most comparable company.
Like a mirror image. I'm trying to find just wondering what kind of premium they would have in multiple places for just their ESG rating. Just curious.
Yeah, so out of my peers, I'd probably say Builders First Source. And that kind of brought down some of my upside a little bit. The reason I actually asked a question by August about it on D2L, why I wasn't pitching it. Actually, the stock prices, it had a market cap of about 14 billion.
Do you know Builder First ESG rating?
It's an A. Yeah.
Okay, thank you.
Rishi.
Yeah, can we just touch on third risk quick? What how often do they kind of introduce new products, and do they give a forecast on their goal for introducing new products going forward?
Yeah, so and their composite segment is where they're really trying to focus on right now. So kind of like I said, kind of just hedge against interest rates a little bit, diversify their three segments a little bit. Their goal is to get composite segment to kind of 33. They're going to try to get to 33 split on revenue by 2025. And they just introduced in this past year 30% increase in product rollouts. And kind of historically, they've been very efficient in their R&D spending as far as the success of product rollouts. And obviously, all of their new product rollouts have a large emphasis on sustainability, which is kind of like I was talking to Dr. Walker about. They plan to have 74% of their products by 2024 be energy reducing products.
Michael gets the last question.
Yeah, good job, Andrew. Could you just talk about composite? Because I know we had removed Trex from the portfolio, but I guess every time I look at Trex, I'm very interested in the aspect of composites versus lumber, especially with lumber prices being very high. And I think going through the write-up, you highlight composites a lot, so just touching on that.
Yeah, so kind of like I was just talking about. So there is a lot of innovation going on in just construction practices right now. As far as just as far as just like there being a pivot from Owens Corning, especially going into more higher value products, which kind of takes away from the cyclicality as well, because they're going to be in these bigger projects that are kind of more long-term based. But yeah, there has been just kind of a big pivot from just normal construction practices to kind of like prefabricated construction materials and just multi-materials as well. So.
Andrew, very good. Thank you. All right, Aidan, we're going to do Helen of Troy, right? My mother's name, Helen. Helen of Crick, I used to call her. Because I grew up in Johnson Creek, so they call it Helen of Crick. All right, Aidan.
Good afternoon, everyone. My name is Aidan McGuire. I'm a junior here in the AIM program. Today I'm pitching you Helen of Troy Limited with a price target of $242.10. Kind of start with my screening process. I really kept it very simple. Kind of wanted to find a company that, much like Helen of Troy, had an effect on people's everyday lives, offered products in everyday households. So I originally came across a company called Autoliv, headquarters in Dublin, Ireland, which is a seatbelt and airbag manufacturer. And after a brief review of the company, talked with Mr. Walker, it was my best interest to kind of move away from that company, kind of try to find something else. And I came across Helen of Troy Limited. When I first read their description, I thought the amount of products they offered, different segments they offered, was something that was really interesting, offering it in housewares, health and home, and the beauty segments. And they offer a number of brands that are common to everybody in this room. Hydro Flask bottles are a popular thing here on campus. OXO brands is a popular kitchen utensil company. And with that, I would say the one question I got on D2L a lot, or a couple times, was about my short interest being at 9.4%. Which to me isn't too alarming. I would say if it went over double digits, it'd be pretty alarming. But after some research, I found that the CEO, Mr. Minenberg, is a regular trader of his stock in Helen of Troy, trading 11 times since 2019. His most recent one being in November of 2021 for a little over 6,600 units for a total of 1.6 million. So I think with this, it shouldn't be too big of a concern, given that it is on a regular basis that he does this on a kind of like a scheduled timeline. With that.
All right, you listed your first driver, the acquisition that was recently done. I know there were questions online about that, but I think it's worth going into.
Right.
Do you feel that they paid properly for it? Does it fit into their integration plans moving forward? And how did they finance it?
Yeah, of course. So they paid $414 million for it, all in cash. And it really helps their houseware segment. Like I mentioned in my write-up, you're able to pair it with Hydro Flask and kind of grow that, not specific, but kind of an implied outdoor category that they're trying to grow upon. something that I mentioned in my write-up is growing at about, I believe, at about a 10% CAGR from 22 to 25. And I think overall it helps the company expand those e-commerce and international that growth that they've been trying to establish. And I mentioned it in my third driver with their transformational strategy. They're looking to grow that e-commerce platform, which was about 26% this past year, as well as international with Osprey packs, half of their sales being internationally. So I think overall, this really helps their business model. It really helps them expand very nicely.
So Hamilton, Bermuda, I haven't been there. I don't know. Have you ever been to Bermuda? I don't think they manufacture there. Is this really a international company?
No, you meant it's much like you mentioned earlier in the week. It's like Texas and Bermuda. Their main headquarters are in El Paso. They have a couple distribution centers in Mississippi with one new center coming in Tennessee this summer. But they really manufacture out of the Asia Pacific regions.
And don't worry, it's legitimate. They are domiciled in Bermuda, so it does qualify for international segment. All right, questions? Bill?
Of course, just on the acquisition, they paid about 3 times revenue, maybe a little higher, 3 times revenue for the acquisition compared to their ratio about around 2 times. Can you help me understand, do they have 50% higher margins in that business that they just acquired to justify that price sales valuation?
I don't know the specifics of the margins within Osprey packs. That's something I get back to on and kind of evaluate. But the specifics I'm not too sure about.
Questions? Great.
I just have a question about your second risk customer reliance. Who are some of these large customers, and do you know like how successful they've been with these large customers in the past, so that they have like long-term contracts?
Yeah, of course. So their largest customer is Amazon, accounting for 20% of their revenues last year. Their second would be Walmart, accounting for 13%, and then Target, which is their third largest customer, accounting for 11%. They have 2 other customers that make up 8%, as I mentioned in their annual report. So they have about 5 customers that make up around 52% of their revenues. With these top 3 customers, they didn't mention any contracts they've had with them. They specifically said they do not have any long-term written agreements with them. It's kind of based on how their products are selling and if they want to continue selling them in stores.
Rishi?
Hey, nice job. So you kind of tune your second driver, HydroFlex and OXO as the key components to generating strong household segment growth. Have you kind of compared them to their peers and seen like how they compare in terms of quality?
Quality as in
Is it
products?
just
or,
their products.
I haven't specifically dove in to the products. I would say, like my one beer Yeti, HydroFlex and Yeti compare. They compare very similarly. I listed them as a peer, and I weighted them pretty highly among the 5 peers. Specifically within my other peers in their houseware segments, I didn't really take a huge look at that, but I can get back to you.
Okay, sounds good.
Okay, back row, couple of you.
Yeah, so when I was pitching Getty, big thing that came up with them was e-commerce growth. Does Helen of Troy have any plans to kind of, I know you mentioned this beginning, did their direct-to-consumer channel, do they have any plans for some e-commerce growth there? And why do you think Getty and Helen of Troy should both be in the portfolio?
Yeah, good question. With their transformational strategy going into phase 2, they're really looking to develop an overall growth of the company through e-commerce, their ESG rating, which is already an A, their diversity, equity, inclusion. So that e-commerce kind of falls in that overall strategy they have for the next couple of years. I think to your second question about adding them to the portfolio, I think Yeti compares to just one part of Helen of Troy when there's 8 other parts to go along with that. So I think by adding it to the portfolio with Helen of Troy offers a more diverse, selective brands compared to Yeti.
Christian?
Yeah, I know you mentioned the overseas dependency. I was wondering if there were any supply chain issues that were notable at all, and also if there isn't any issues at all with input prices rising for materials.
Supply chain issues haven't arisen yet. It's something they just mentioned as a risk. It could become a large issue in the future as 80% of their finished goods purchased are manufactured out of the Far East. So as of right now, it's not an issue, but it could potentially grow into something in the near future.
Thank you. And then I was just wondering about input prices. If any of the stuff, the materials that they're using have gone up, within the inflation or anything in the past year.
Not that I've read as of right now, no.
John, could you just talk about how you came to the 1.75% terminal growth rate?
Yeah, of course. I would say, having been in the portfolio twice, it's seen a good growth to it. With the first being pitched around 100 and it coming out about 140. I want to say the first time it was pitched. I just think with the business model they have, with the products they're offering, the acquisition, where they plan on going in the future, I see this 1.75 growth rate as an appropriate growth rate for where they see them accelerating to.
Awesome, thank you.
Dom,
Hey, so just a quick question. So pertaining to your second driver regarding the housewares segment and the outsized growth, did you find anything like regarding the margin profile of that segment? And, as it's grown as a percentage of the total sales mix, have your operating margins expanded?
Yeah, in particular with the housewares segment, as I showed you in the second driver, their 5-year CAGR at 19% is the highest among their 3 segments. The highest it's hit in terms of percentage of company revenue was fiscal year 20 when it hit 37.5%. And that just was because of the coming off the pandemic, everybody kind of investing in that segment of the company. Historically, from about 2012 to 2016, 17, it stayed around the 20% of the company's revenue, jumping to 27% and steadily increasing before taking a little decrease in 21 to 35%. So overall, from the from the past, it's kind of stayed at the same percentage of the company.
go ahead.
And like, have operating margin expanded during that time period? Like, has the growth been outsized or kind of relatively flat?
Operating margins have been a little all over the place. In 17, they were around 11%. Next year, they were at 11.3 to then 12.75 to 10 and then 13. So part of my model is I kind of increased them to 14%. And I kind of had them flatline for the next couple of years. If a supply chain risk does come up or supply chain risk does come up, then I can reevaluate the model. But as for right now, I thought that was appropriate.
All right, Aidan, thank you. Nice job. All right, our third presentation is another international stock. And Zach, all set?
Yeah.
All right.
All right, thank you. My name is Zach Turbett. I'm currently a junior here in the AIM program, and I'm pitching STMicroelectronics with a price target of $60.44. Kind of how I kind of screened for this company. I originally was using kind of the same screener I used for my last pitch, which was looking at like high ROE, constant revenue growth. But I wasn't really having much luck in terms of companies that both interested me and had strong financials on that side. So then when I was watching the news, a lot of what was in it was this new semiconductor and chip bill. So I decided to kind of go in that route. I think last semester there was a company called Taiwan Semiconductors, which was pitched. So what I did was kind of start with that company and look at all their peers and ended up on STMicroelectronics. And what kind of drew me to them is that they're based out of Sweden and a lot of their manufacturing plants are in Italy and France. So it's kind of away from all that competition there in the Asian countries. One thing I kind of want to touch on in detail is about my third risk, which is about the U.S. CHIPS Act. And I kind of want to explain that because it's a little bit confusing and it's a little bit of a long explanation. So I apologize on that part. So basically, the Senate and the House have each their own different bills. So the Senate's bill is called Innovation and Competition Act, which was passed last June. And then the House has something called the Competes Act, which was passed this most recent February. And though they are fairly different, one thing they do have in common is that they both want to fund domestic manufacturing of semiconductors. And so they're both currently working on combining both of their bills to create one, which would then be called the CHIPS Act. That'll be then addressed to the president later on. So I guess kind of the main question is, will it get passed? Eventually, I think it will get passed. I know Biden is pushing for it very strongly. But knowing kind of our governments, they move very slowly. So they take a long time to get things passed and laws. So, I mean, if I had to estimate, it would probably take many months, if not until 2023, until this does become a law. And kind of the main thing the main reason why these bills are kind of being pushed is to increase competition with China, Taiwan, and Japan, and compete with their semiconductor manufacturers. I know in the United States, global manufacturing, they had around a 30% market share in 1990, and now they're at 12% today. So it's not more so of them trying to get ahead, it's more of the United States trying to catch up in terms of manufacturing. And yeah, with that, I will leave it to questions.
All right, well, good. I'll ask the first, kind of short one. Christian, you're next. European company, even though they're international in terms of their sales.
Yeah.
We know what's going on in Eastern Europe. Any impact there whatsoever?
Not that I've been aware. With most of their manufacturing facilities in Western Europe and France and Italy, they don't really have anything more east of that. So as far as reading in the earnings call, most recent earnings call, and first report, this doesn't seem like it's impacting
And
them
markets
that much.
not impacted?
No, as far as I know.
Okay.
I've read, no.
Christian?
Yeah, I was wondering if you did a country risk premium at all.
No, but I did add 50 basis points, just kind of reflects that it being an international company and
Okay.
kind of the current condition of the semiconductor market.
Okay, yeah, so I guess you didn't, I don't know, I didn't really see any like major risks with Switzerland. I know, like, because when we did the, the Taiwan stuff, obviously there were bigger risks there, so.
Yeah.
Probably just,
Yeah, actually, Damadoran has
Yeah.
Swiss risk like less than US.
really?
Yeah.
Okay.
Yeah.
Yeah, no, that makes sense. I was just curious.
With Apple making up about like 20% of your revenue in their recent initiatives to like try to design and manufacture their own chips, like do you see that as like a risk at all to your company?
I don't really necessarily see it as a risk, though they do kind of make up a big portion. That's more so what they're selling to Apple is kind of second tier silicone solutions. So that'll be more like microcontrollers and kind of like sensors. So like their sensors will be used for like face authentication, which is in all iPhones and stuff. So it's not more so the semiconductor part of it, but more the other segments that they're kind of pushing towards Apple.
Bill?
I'm confused with your second driver, the strategic cooperative agreements. How does their relationship with Tower and the other one?
Cree? Yeah.
How does that, do they sell them wafers? Does Tower, does STM buy the wafers? What, I don't understand. You talk about wafer growth of 6%, but
yeah,
if they're just looking for supply, that's not a good figure.
Yeah, so they're doing both. So because production, they have like a backlog of around 18 months currently, and they're all sold out for 2022. So they're both manufacturing their own and buying off of Cree. So the partnership with Tower Semiconductors, Tower Semiconductors is using one of STM's clean rooms, kind of like a manufacturing or engineering kind of room in one of their facilities. And then in return, Tower Semiconductors provided them with a lot of the equipment to make a lot of these wafers. And then Cree, with that $800 million kind of investment, they'll be providing STM with more wafers.
So tell me, how is it shareholder like that?
More production. So especially with efficiency. I know that.
More production, therefore more revenues coming from them.
Correct.
So the 6% growth rate that you quote is not necessarily a product line sale for STM.
Well, that's like the wafers are kind of a main piece to make semiconductors. Like you can't make a semiconductor without wafers.
Well, I get that, but how are they, we can talk offline.
Okay,
It's just
yeah, so I guess.
That was my question.
That was your question.
It was about the deal specifically.
Okay, Andrew?
All right, so I have a couple questions from the evaluation section. your WAC looks really good, I like your growth rate, I like your DCF. I'm more concerned about your relative valuations of your group.
Sure.
So could you kind of sell me on why you used a 4 and P multiple, but not 4 and P to EBITDA, and your confidence in this EBITDA, which seems to be driving a lot of upside?
Yeah, so yes, actually looking, the peers did kind of give me a lot of trouble. Looking at all my metrics and looking at almost all the companies I kind of looked at, probably around 15 companies to include in this, they were getting upside from almost every company that I looked at. So I decided to choose a lot of the peers from what STM used in their annual reporting. And originally the PE ratio was giving me around 200% upside. So that's kind of my reasoning behind using that 4 PE. And a lot of it is coming from monolithic power systems, which is why I only weighted them at 10%. I did, in fact, take them out just to kind of see if I saw it upside, and I did. So I felt fairly comfortable doing that as well. And yeah, does that kind of answer your question?
So if your 4 P is giving you that much, or if your regular P is giving you that much upside, then it should be the same with the 4 P that you get up. It's giving you about the same upside, and you left it as this year's.
Okay. Yeah. I feel fairly confident about just weighing that 10% and having that kind of just weighing down most of it.
Hey Zach, nice job. Can you touch on your first driver and that technology they're releasing soon that like Sense 3 and maybe quantify a little bit with maybe marginal growth and revenue growth in the coming years?
Yeah. So I have the Flight Sense attributing around 7% of top line revenue sales, and then the microcontroller that will be used for electric vehicles attributing I think at 5.25%, and the rest of that 7.25% that you'll see is a combination of both the partnerships and that second driver, and with the estimated kind of a shortage of semiconductors kind of easing and improving dramatically.
Bill, what's their exposure to iPhones or specifically Apple?
I'm not sure if I quite know the answer to that question in terms of what exactly is exposure.
Well,
Like how much they correlate?
I did some research before reading this up. I'll fault you for this. This is Apple's about 20% of their sales, and there's other handhelds that they sell into as well. So there's a factor issue, concentration issue with Apple and other people too. So that'd be pretty, from a concentration standpoint, that would be a risk to be concerned about. So
okay.
All right, other questions? By the way, the Bitcoin 2022 conference is on the screen up there. So if anybody sees Dr. Wall walking behind there, let us know. Okay? 'Cause that's the conference he's at, by the way. Well done. Thanks.
Thank you.
Well, Chris, some big shoes here to fill. 3 strong pitches. What do you think?
Good people, tough people to follow, but we got it.
I said you got your Owens Corning colored tie on.
Yeah. Decided to go a little bold today, I think.
All right, floor is yours, Chris.
So company I'll be pitching today is FIVN, ticker FIVN, with a price target of $161.28, representing an upside of $38.65%. Kind of how I screened for this stock. My last stock was kind of a stable company, stable revenues. I kind of wanted to get a little bit more of a challenge for this one, kind of develop my skills. So I found a company that did not have positive earnings to increase kind of the challenge, give me some of that exposure to a different type of tech stock. And obviously tech is a tremendously growing industry. So it's kind of why I decided to go with FIVN, and also just the expectations for them in the future is remarkable, and a lot of people love this stock, and I can see why after really doing the research of it. So that's kind of my screening. Kind of one of the main questions that I got in D2L is kind of on my third risk. And for the seniors in the room, I did have one typo in my third risk. I said I said was able to sell their IP. I meant to say steal. So I got a question on that, and I was very confused as I read it. So I went back to my write-up and noticed I had a mistake. So I corrected that, and I think everyone in our class kind of realized that. So kind of protecting their IP. Obviously, being a tech company, IP is a very important thing to their company, and it's kind of where they get all their revenues. So touching on patents, their first patent was issued in 2011 and doesn't expire until 2031 with a 20-year patent life. So there's not too much worry in that. And honestly, even if they were to release the patent now and let other people use it, they're developed so far past that it doesn't really pose that big of a risk. In terms of kind of stealing their IP and someone taking it, I kind of looked into FIVN's security when it comes to information and their stuff, and they have. I didn't even know there was this many regulations and laws that people followed, and they comply with every single one of them, and even more than they posted. And then they also just partnered with Pindrop, which is a company that delivers security, identity, and intelligence for voice. And obviously, being a contact center, a lot of it's through voice. So having that protection for their customers is kind of a huge advantage for the company. So with that, I'll open it up to questions.
All right, I'll ask the obvious question. When does ROIC go positive and catch up with WAC?
Yeah, so that was also obviously another obvious question that I knew I was going to get asked. So in 2023, I have the ROIC reaching a 6.77, which is obviously just below. And then 2024, the ROIC reaches about 15%, which so somewhere between 2023 and 2024, that will flip and cause the ROIC to be greater than that.
Okay, I saw a number of hands here.
Hey, Chris, good job. I was just wondering how the CEO has integrated himself in the company, having just been there around 4 years.
Yeah, so I'll kind of touch on some of the management change. So Mike Berkland is now the chairman of the board. He was the previous CEO and president. The reason that he kind of switched out of that role is they just kind of stated it as health issues. So they didn't want him under that high stress of being the CEO. So they moved him to the chairman, and obviously he was there for 10 years. So he knows the company inside and out. So that's a great chairman to have. And the CEO, as I kind of read the report when they switched over, Mr. Trollop, I think is how you pronounce it, is a well-respected person in the industry, highly sought after for an executive level position. So they believe he's the right person to kind of bring this company to new levels.
Cool. Christian.
Yeah, my question is kind of maybe a little explanation on your comp table. And the reason I'm curious is that, I don't know some of these companies very well, but I see that revenue for your company is under half of what some of the other ones are, but your profitability metrics are a lot better, like ROE and ROA, than some of the more, looks like maybe more established competitors. So I was curious just what stage of growth FIVN is compared to the rest of your comps, and maybe if any sort of competitive advantages you see in their actual business structure that's allowing them to get these better profitability metrics.
Yeah, awesome. Thanks for the question. So yeah, obviously FIVN is a lot newer of a company than some of my other peers, but kind of in the area of choosing my peers, that was kind of the hard part, because like Andrew had, a lot of my direct peers were private companies, companies that had not gone public, so I didn't have the information on them. And some of those companies were kind of in the same stage that FIVN is in. But all four of my companies that I've used in my comp table were mentioned in the 10K as direct competitors of the company, as obviously mentioned by management. So I have full faith in my competitors. And then kind of to touching on your ROA and ROE, FIVN does really have a competitive advantage. Their product that they sell right now is so far above kind of what their competitors offer, and a lot of companies are starting to realize that and realize kind of the benefits. And kind of COVID, obviously, when you're a tech company, an automation company, everyone kind of has the speculation that their growth is because of COVID, because everyone was at home. But I believe that, yes, it did kind of contribute, give them a little bit of a tailwind for their revenue growth. But I believe that kind of getting some of that exposure and people really kind of almost being forced to test out their product really kind of shows that it's a well-tested product, doesn't bring down customer satisfaction and actually triples agent productivity. So kind of some of the labor shortage that we had really helped out some call centers.
We're gonna go, we have more questions, so we'll kind of speed along here right now. Bill, you first, then Maddie, then Richie, then Andrew.
The IBA product that you're introducing, what's the magnitude of that product to the revenues going forward?
So that was one thing I really kind of struggled with. Since it's kind of the first in class, management didn't really give much guidance on kind of the growth of it, just because no one's had it before. No one really knows kind of the growth
How
of
about
it.
this question, what was the percentage of revenues in the most recent quarter for IBA?
It was 10%.
And that compared to what, previous quarter or year over year?
Well, it got introduced in June of 2020, so it was almost like less than 1%.
10% of your product. Okay,
Yeah.
very good. Did Matt? Andy.
I'm just curious, great job, great pitch. But with two of your drivers and one of your relative multiples being kind of revenue focused in nature, could you just kind of walk us through your revenue build and like how your numbers, your expected like 30% growth rates are with guidance and with the street estimates?
Yeah, absolutely. So management gave great guidance until 2026. They predicted that they were going to reach 2.4 billion in sales, and honestly, in 2026, I was about 100 million below that. Just kind of how it worked out. But they predicted a little bit over, somewhere between like a 31% CAGR going forward, with a 29% growth in 2022 as they kind of, attract more larger customers. So they really kind of gave me great guidance until 2026. And this is kind of also just with the expansion into international markets. A lot of their expansion is not closely related with the Russia-Ukraine conflict, as I knew that question was going to come up. They've kind of, done Western Europe, focused on a lot of great countries over there that aren't kind of dealing with the war. And then obviously just kind of some of the competitive advantage they have: best in class product, great product, well tested. And then obviously they've had a 30.3% CAGR over the last 5 years. And reading back on some of the earnings calls, management predicted about 20, so they kind of shattered those expectations. And I believe that they could honestly shatter them again in the coming years.
So just to follow up, are you arriving to your top line? I'm just curious from a modeling perspective, like by international market, like is that what's driving then your like just from a technical modeling perspective?
A little bit. They predicted that, or management guided that so it's at about, it is about 9% right now, and they predicted it's go to about mid to high teens % of their revenue. So that's a good growth as they continue to grow in the United States and kind of gain some of those larger contracts. One of the things that kind of on the larger contracts topic, they have booked a $1.7 million IVA booking. That was one of the disclosures that they gave. Very minimal disclosures, just because they're very private. They don't want people really knowing what companies they work with. But also just kind of they've booked a Fortune 25 company, one of the largest retailers. Again, they don't give me names. A global health insurance with over 80 million members worldwide, a peer-to-peer lending company, and a fast food chain. So they can really do all industries, which gives them kind of versatility.
All right, we're going to shorten the questions and the answers. Rishi.
Awesome. Can you just defend your margin structure a little bit? These tech companies have trouble maintaining high margins because they need to reinvest in R&D and sales. And just because you're expanding Europe, isn't that kind of a risk to those assumptions?
Yes, that was my second risk, is kind of the international expansion. But management kind of guided with the larger contracts. It's kind of an economies of scale. Also with just getting more contracts, it's kind of the less labor that they have to spend to get these companies' software up and running and get them to kind of full capacity. And then also with one of the things that they're kind of investing in the R&D is a service called Conversion Architect, which kind of takes away a lot of the coding part of, kind of building the structure, making sure it's up and running, so that you don't have to have, you can just kind of have business knowledge, and you don't have to have the AI expertise to kind of get it going. But yes, I actually have my R&D above kind of the street just because being a tech company, R&D is huge. You don't want to kind of lose that competitive advantage.
Just really quick, do you know how much it costs to acquire a customer?
I do not.
Okay, that's fine.
Andrew? Yeah, so you mentioned IP and patents earlier. Did you do any evaluation of what the IP and patents are worth? Did you do a per share evaluation, kind of give a downside of what the company's worth, less than?
I did not. I can get back to you on that too if you.
Michael, last question. Good job, Chris. Could you talk about, because I see in your peer evaluation, you use fiscal year 23 estimates. Where were you pulling those, or just how did you come to those? I guess, because what, 2 years out?
Yes. So one of the reasons why I kind of want to do a forward looking is just because they're negative earnings. So kind of their ratios are crazy with negative earnings. So kind of going 2 years out, a lot of the street has them predicting going net income positive in 22, but I believe kind of as I was telling Rishi, investing in the company, keep developing the product. So I have them actually going net income positive in 20. The street has them at 22 going net income positive. I have them at 23 because of that, investing in the company. So I kind of wanted to do an outlooking just so it makes it a little bit more.
Where'd you?
Oh, fact set. Okay.
Chris, thank you. Max is our last presenter. Normally we like it when you bring samples. In this case, with Freshpet, I'll take a pass. All right? Yeah, boom.
What a knee slap. I didn't register for that class.
I
Neither
don't
did Maddie.
in that class either. I'm not
You got nothing on us.
All right, last presentation of the day, Max, Freshpet.
All right, perfect. So, obviously pitching the Freshpet, price target of 130, representing 22% upside. In my screening process, I was really looking for a growth company that showed really kind of upside in the revenue department, just kind of skyrocketing, told a good story. I was really debating between Freshpet and Hostess, the drinking company. Then we had our speaker with Wasatch Advisors, and Mr. Malooly was talking about Freshpet. That's when I really decided to give a deeper look, see what this company was all about. And that's when I realized kind of they had this extreme growth strategy that should lead to more upside in the future. So that's really where I picked Freshpet from. And then to address some questions I got in D2L. First thing with my competitors, Freshpet's one of the only companies that has their own fridges in grocery stores. So it's really hard to find competitors that represent the same type of business model as Freshpet. So I really struggled to find peers that were comparable to the company. And then kind of going back to my boxes with ROA, ROE, ROIC, I see ROA and ROE becoming positive once Freshpet has a positive net income, so that'll be in 2023. And then ROIC will be catch up to the WACC, and that's not going to be until 25, 26 because of that net income being so low. So at this time, I'll open it up to questions.
All right. Let's open up the floor right over here.
Nice, good job. I was just wondering, with the products they already offer, are they looking to expand the diversification that they offer currently, or has management announced any plans for the future?
Yeah, definitely. So they're, as a growth company, they're big into innovation, stuff like that. Right now, they offer 7 different brands of dog food and then 3 different lines of cat food. Management's really not transparent at all with kind of the innovation. When you read the reports, it's more like look out for innovation, see what's coming next. So as for specifics, I can't really give you those details, but right now they offer products that have like chicken, the proteins are chicken, turkey, and then beef. So I can see maybe as an idea, maybe introducing a new protein. But as far as right now, I can't give you the specifics.
Yes.
Great job, Max. Do you think you could just kind of walk me through your model a little bit and explain to me how exactly Freshpet went from losing about 25 million in operating income to going up a million?
Definitely. It's a fair question. I think so. The main reason where my model's assumptions come from, a lot of them come from historicals. So if you look at kind of their 2017 to 2018 range, they were operating around a 47% gross margin. And then all these supply chain issues came in, and inflation came in, and that's when Freshpet saw all these problems with basically fulfilling inventory, and their supply couldn't meet their demand. So I assume kind of through a slow process that Freshpet would eventually, through introduction of these manufacturing facilities, would be able to get their margins back down to where they were in 2018, and operate around a 45% gross margin by 2025. And then I also got some guidance from management through the household penetration. They aim to have 11 million households by 2025, and they assume that with the 11 million households, they can do about 1.25% or billion in revenue, and then at that gross margin, that's when that operating income comes from.
To quickly throw in, if those supply chain issues happen again, was there any guidance on how they're going to mitigate that risk so they don't lose so much?
Yeah, definitely. So in the earnings report, that was kind of the main focus. Like, we have the growth strategy, but right now we just can't meet what our clients want. And so that was that's their main focus right now, and the fact that so the main way they're kind of combating that is through their production facilities. Like I said, in 2020, they introduced a second one, and now they're building a third one in Texas. Another way they're combating is just their running inventory. So in the past year, inventory wasn't fulfilling their needs. Right now, though, they're doing roughly, call it 490 million in sales. They run inventory around 600 million, just to kind of have that fallback option to say, okay, let's say revenue increases more than we expect. We have this inventory to fulfill these orders.
Beautiful. Thank you.
Basil?
Yeah,
Good,
so
good.
could you walk me through how your company has a competitive advantage compared to pet companies?
Yeah, definitely. So knowing that there's a bunch of healthy dog food options out there, I think the main competitive advantage that Freshpet has is with their fridges. A lot of these companies don't have their own brand and their own fridges in these pet stores. And then having those fridges means that Freshpet doesn't have to put preservatives in their food. If you don't have a fridge, you have to put preservatives in your food. So basically, Freshpet can kind of guarantee that they have the freshest food in the market.
Yeah,
And then Christian.
I have a question on your third about pricing versus ingredients. So do they actually own this protein being added into their food, or do they buy it from a third-party source?
So they buy it from a third-party source, yeah.
Okay. So do you know what kind of prices they pay on this, or what kind of margins they make on this protein?
I do not have those numbers for you, but what I can tell you is to kind of combat that inflation, kind of the lack of protein out there, they introduced a price increase, and so they think by introducing a price increase to their products, they'll be able to combat inflation and kind of cover this risk.
And then do you know if they use any options trading or swaps to kind of hedge these prices or derivatives?
I do not have that information.
Christian?
Yeah, so with the 10-year DCF, I was just wondering if we could get a little bit of information going on further as far as, your assumptions for price to earnings or ROA or any sort of performance metrics like that, and what that'll look like, 10 years from now.
Yeah, definitely. I think price to earnings, kind of starting with that, it's going to be very high. Just seeing that earnings is earnings are going to be low going into like 25, 26. And then that price is hovering right now around 100, and with my price target of 130, that's just naturally going to lead to a higher price to earnings. And then for ROE and ROA, I think it's just going to be a continual steady increase, seen as net income is going to kind of relatively increase at these assumptions that I have, that I think it'll kind of keep repeating myself with just that steady increase.
Yeah, and then just quickly, how confident are you that management can pull this off on a long-term play?
Yeah, I'm extremely confident. I like the experience that they've had. They have backgrounds in other pet food companies, and then just kind of from their reports and earnings calls, there's a kind of a sense of confidence there in that we mean business. This is going to get done.
Okay, thank you.
Yeah.
Here's what we're doing. Anwar, Bill, Alex, Grace.
Yeah, so you mentioned that that Freshpet has their own fridges.
Yeah.
So I guess my question is, what's the useful life on these fridges, and how did you forecast your CapEx going forward? Because I'm assuming with these type of growth rates, they probably have to spend a lot of money on these fridges. And what kind of impact did that have on your free cash flow?
No, for sure. So for the useful, I don't have the exact year for Freshpet fridges, but what I can tell you is that this company since 2006, and their fridge numbers have only increased. So I'm assuming that useful life has got to be somewhere around 15, 20 years, if not more. And then could you repeat that second half of the question?
Yeah, so how did you forecast your CapEx?
Yeah, CapEx, I just kind of relatively increased it year over year, seeing with that store growth and all that other growth that you're going to have to install one fridge. And while the price of installing a fridge is relatively cheap, compared to like their revenue, it just kind of that increase, and then that would obviously decrease my free cash.
We just checked, useful life, commercial refrigeration, 10 years.
Okay.
So,
Do they capitalize their refrigerators or do they expense them? in their income statement?
I do not have that information.
take a peek at that when you do your buy, sell, mention that. Alex.
Yeah, sorry, continuing with, great job, by the way, continuing with the fridges, what overall, like, with that expensing, how does management plan on, because like kind of what Amar is saying, like, you're adding all these new stores and all the sales, and then there's a lot of costs, and then with the supply chain issues, so how are they able to keep up with this demand of new fridges to, you know, I understand they're doing stuff for the product, but for the fridges themselves, because that's big for brand identity and all that.
Yeah, so basically, are you asking kind of how are their revenues?
Well, how are they gonna, like, how is management keeping up with like the creation of these fridges? Is that included in this new plant operation, you know, being launched, or is that more?
That's a good question. I don't have that information exactly for you right now. I can get back to you on that.
Perfect, thank you.
Great.
Oh yeah, I just had a question, kind of like model what Kristen asked. So you said that EPS would still be staying pretty low, but the minimum growth rate is like 250%. Can you just touch on that?
I can. I realize I missed both. Seeing in this box, I have EPS kind of getting up to by 2024 at 30 cents, and then it said with the kind of higher increases in net income, it should get up to I think roughly like $3 to $4. And so with that, price to earnings will decrease slowly over time.
Rishi.
Nice. So I guess my question is, can you kind of defend why we shouldn't like buy an online retailer like Chewy instead of Freshpet, since they don't have their own? And can you kind of break down and take rate that these online retailers take for being a third party for Freshpet?
Yeah. So I think to answer that first question, why Freshpet, it's going back to Basil's question with that competitive advantage and just having those fridges and being able to provide the healthiest dog food with more and more Gen Z babies entering adulthood and having that kind of consumer idea to eat healthier, and pets are being more, we care more about our pets these days. We want the best dog food, and that's where Freshpet's going to get a step ahead of Chewy and those competitors. Could you repeat that second question for me?
Yeah, like what's the take rate that a Chewy or an Amazon takes when they sell Freshpet products?
I do not know.
Okay. Sounds good. Just back to the first question. So you have a company like Chewy, right? They sell Freshpet plus 100 different brands. Like, why just own them? Because they own every dog brand, cat brand, fish brand, etc. Would it just be better to own them?
I think so.
Okay, fair enough.
Last question is Michael.
Good job, Max. My question is, have any of the competitors, or say like Petco or anybody else that makes dog food, cat food, stuff like that, have they tried to implement, I guess, a refrigerator strategy, or is this kind of like, you know, Freshpet does this and we stay away from it?
It's kind of that we stay away from it. It's just kind of Freshpet already has that much of the market share and has that infrastructure to have those fridges to where it's kind of a waste of another competitor's time to even try not to market it.
Thank you.
This is clearly the ink pitch where we've discussed refrigerators more than any other. Max, thank you very much. All right, those were the 5 pitches this week. The presenters will come up and meet with Bill and I just briefly to talk about buy-sell recommendations. The ballot will go out tomorrow morning. Everyone have a good weekend. We're not here next week because we're off for the Easter break. So we'll see you in a couple or 3 weeks. Have a good weekend.
I was like, were you okay? I was so confused. I was getting mad again. What the hell did you say to me?
No, fresh, just give
I don't care. So nervous. And you asked a good question.
I always ask good questions.
Always.
No, you're when you're until you.
Oh, really? I can get like 5 minutes later. I was thinking about moving over here, but
I went all the way out to focus on this shit. My dick was
not next week, maybe the week after. Friday or Good Friday. Yeah, it's not a Good Friday.
You got resurrected.
Just wait 72 hours. It's funny. You guys are.
But wait, there's more.
Yeah, I got, well, I wanted to.
Something, what, Wallace thinks something about like.
Yeah, so what happened?
There's,